Most traders believe stress comes from losing money. It doesn't. The biggest stress in trading often comes from uncertainty. A trader can sit through a planned loss and remain calm, yet the same trader can become anxious while sitting on a winning position. Why? Because stress is not created by the market itself. It is created by the conflict between what is happening and what we want to happen. Think about that for a moment. Have you ever noticed how your stress level rises the moment you start watching every tick? The market hasn't changed. Your account balance may not have changed, but your attention has changed. Suddenly, every movement feels important. Every pullback feels dangerous. Every candle looks like a warning. Why does that happen? Because the mind begins searching for certainty in a place where certainty does not exist. The market offers probabilities. The stressed trader demands guarantees, and the gap between those two realities creates pressure. Now here's where it becomes interesting. Most traders think stress is a problem they need to manage after it appears, but stress is usually a symptom. The real cause happened earlier. It may have started when the position size was too large. It may have started when the trade was entered without a clear reason. It may have started when expectations became attached to the outcome. The stress you feel during the trade is often the bill arriving for decisions made before the trade. Have you ever entered a position and immediately felt the need to defend it, to justify it, to monitor it constantly? That behavior reveals something important. When a trader truly accepts risk, observation becomes easier. When risk is not accepted, every market movement feels personal. The trader is no longer reading information. He is searching for reassurance, and reassurance is expensive in this business. The market has a habit of exposing emotional weaknesses. If fear is present, volatility amplifies it. If impatience is present, waiting magnifies it. The market rarely creates these traits, it simply reveals them. So what should you look for? Watch your behavior more than your emotions. Are you checking the chart every few minutes, even though your setup requires hours? Are you moving stop losses farther away? Are you taking profits earlier than planned? These actions matter because behavior is measurable. Emotions often become clear only after the damage is done. Notice the chain reaction. Stress leads to urgency. Urgency leads to impulsive decisions. Impulsive decisions lead to inconsistency, and inconsistency eventually destroys confidence. This is why experienced traders spend so much time preparing before the trade. They understand that discipline during execution is often the result of preparation beforehand. Ask yourself, if your position were half its current size, would you still feel the same pressure? The answer to that question reveals more about your risk management than any indicator ever will, because the goal is not to eliminate stress completely. Some level of discomfort is natural whenever money is at risk. The goal is to keep stress low enough that clear thinking remains possible. When stress becomes the loudest voice in the room, analysis disappears. Decisions become reactions, and once a trader starts reacting instead of observing, the market begins pulling him from one emotion to the next. Which is why the most valuable question during any trade is not, what will the market do next? Most traders think stress comes from the market. They think the volatility is the problem. They think the news is the problem. They think the sudden price movements are the problem. But if that were true, every trader looking at the same chart would feel the same level of stress. They don't. One trader watches a sharp pullback and remains calm. Another trader sees the exact same pullback and feels panic rising almost immediately. The chart is identical. The market is identical. So what changed? The size of the risk. This is why stress is often a position size problem before it becomes a psychology problem. Many traders spend years trying to master their emotions while ignoring the one factor that creates most of those emotions in the first place. They focus on mindset, confidence, discipline, and mental toughness. Those things matter, but they matter less when the trade itself is placing unbearable pressure on the mind. Think about it. Have you ever entered a position and suddenly found yourself staring at every candle? Every tick feels important. Every small move gets your attention. You tell yourself to stay calm, but your mind keeps returning to the chart. Why? Because somewhere in the background, the risk feels too large. The brain responds to perceived danger. It doesn't care how good your setup looks. It doesn't care how much experience you have. If the potential loss feels significant enough, the brain shifts its focus from making good decisions to avoiding pain. That is where stress begins. The interesting part is that most traders don't recognize this happening. Instead of questioning the position size, they question themselves. They say, "I need more confidence." They say, "I need better emotional control." They say, "I need to stop being fearful." But what if the fear is not the problem? What if the position is simply larger than your mind can comfortably manage? A trader risking 1% of capital and a trader risking 10% may be looking at the same opportunity, but they are not experiencing the same trade. The first trader can think clearly because the outcome of a single trade does not threaten him. The second trader feels pressure because too much is riding on the result. Pressure changes behavior. It causes traders to exit winners too early because they want relief. It causes traders to move stop losses because they want to avoid accepting a loss. It causes traders to enter and exit repeatedly because they cannot tolerate uncertainty. Notice the pattern. The problem appears emotional, but the source is often structural. When risk becomes excessive, stress increases. As stress increases, objectivity decreases. As objectivity decreases, decision quality declines. And once decision quality declines, the trader starts creating losses that have nothing to do with the original setup. This is why reducing position size can sometimes improve performance almost immediately. Not because the trader suddenly becomes smarter. Not because the market becomes easier, but because the mind becomes quieter. A quieter mind sees information more clearly. A quieter mind follows plans more consistently. A quieter mind can wait. And waiting is one of the hardest skills in trading. Ask yourself a simple question. If your current position were cut in half right now, would you feel different? Would you stop checking the chart as often? Would you worry less about every small fluctuation? Would you be more willing to follow your original plan? For many traders, the answer is yes. That answer reveals something important. The stress was not coming from the market. The stress was coming from the amount of exposure. Professional traders understand this principle better than most people realize. They know that survival depends on maintaining clear judgment. They know that clear judgment becomes difficult when too much capital is attached to a single outcome. That is why experienced traders often appear calm during situations that make newer traders nervous. It is not because they have eliminated fear. It is because they have structured their risk in a way that prevents fear from taking control. The goal is not to prove how much risk you can tolerate. The goal is to trade at a size where you can still think clearly when things don't go your way. Because the moment a position becomes large enough to control your emotions, it has already become large enough to control your decisions. Many traders blame the market for their emotional reactions. They blame volatility. They blame unexpected news. They blame sudden reversals. They blame market makers, algorithms, or the unpredictable nature of price movement. But the market is doing what it has always done. It moves. The real question is this: why does the same market create different reactions in different traders? Have you ever noticed how one trader remains calm during a sharp decline while another immediately feels fear? Or how one trader stays patient during a slow, moving market while another becomes restless and starts forcing trades? The market is the same. The difference is the person observing it. This is why the market doesn't create stress. It reveals it. The market acts like a mirror. Whatever already exists beneath the surface tends to become visible once money is involved. A trader who struggles with patience in everyday life often struggles with patience in trading. A trader who constantly seeks certainty often struggles with uncertainty in the market. A trader who hates being wrong often finds it difficult to accept losses. The market did not create those traits. It exposed them. And that exposure can be uncomfortable. Most people believe they know themselves well until they start trading. Then they discover emotions they rarely noticed before. Fear appears. Impatience appears. Greed appears. Self-doubt appears. The market simply provides the environment where these qualities become impossible to hide. Think about what happens when a trade moves against you. The chart doesn't know who you are. The market isn't attacking you. Yet some traders immediately become defensive. They begin searching for reasons why the market should reverse. They ignore information that contradicts their opinion. They hold losing positions longer than planned. Why? Because the trade is exposing something deeper than a market decision. It is exposing the trader's relationship with being wrong. The same thing happens on winning trades. Many traders assume stress only appears during losses. That's not true. Some traders become even more emotional when they are making money. They constantly check profits. They fear giving gains back. They close positions too early because they cannot tolerate watching unrealized profits fluctuate. Again, the market didn't create that behavior. The market revealed an existing fear of loss. Money simply made it visible. This is one reason trading is such a unique profession. In many areas of life, weaknesses can remain hidden for years. In trading, weaknesses tend to appear quickly. A lack of discipline becomes visible. A lack of patience becomes visible. An inability to manage risk becomes visible. The market has a way of bringing these things to the surface because every decision has consequences. And that's why two traders can learn the same strategy and get completely different results. The strategy is only part of the equation. The trader executing it is the other part. Have you ever broken your own trading rules? Most traders have. The interesting question isn't whether it happened. The interesting question is why. A trader may know exactly where the stop loss belongs and still move it. A trader may know exactly when to exit and still hesitate. A trader may know better and still make the wrong decision. The market didn't force any of those actions. The market simply revealed pressure points that already existed. This is why lasting improvement in trading requires more than finding better setups. You must observe your own behavior. Pay attention to the moments when emotions become strongest. What situations make you impatient? What situations make you fearful? What situations tempt you to abandon your plan? Those moments contain valuable information. Most traders see emotional discomfort as something to avoid. Experienced traders often see it as feedback, because every emotional reaction points toward an area that needs attention. If a small loss creates panic, there is something to learn. If missing a trade creates frustration, there is something to learn. If a winning trade creates anxiety, there is something to learn. The market keeps presenting situations, and each situation shines a light on a different part of the trader's psychology, which is why the most important observations often have nothing to do with the chart itself. Most traders expect losing trades to be stressful. That makes sense. Money is being lost. The position is moving in the wrong direction. Uncertainty is increasing. Nobody enjoys watching a trade fail. But here's something many traders don't expect. Some of the highest stress levels in trading appear during winning trades. At first, that sounds backwards. After all, isn't making money supposed to feel good? Isn't a profitable position supposed to create confidence and relief? Sometimes it does. But often, something else happens. The moment a trade starts working, a different kind of pressure enters the picture. Now the trader has something to protect, and protecting profits can become more emotionally demanding than accepting losses. Think about it. Have you ever watched a trade move nicely into profit, only to become more nervous than you were at entry? The trade is working. The analysis appears correct. Yet instead of feeling calm, you find yourself staring at every candle. You start calculating profits repeatedly. You begin imagining what could happen if the market reverses. Why? Because unrealized gains create a psychological conflict. The trader wants more profit. At the same time, the trader fears losing what has already been gained. Those two desires begin pulling in opposite directions, and that internal conflict creates stress. A losing trade usually presents one obvious problem. A winning trade presents multiple possibilities. Should you hold? Should you take partial profits? Should you move the stop loss? Should you let the trend continue? Should you lock in gains now? Every new decision creates uncertainty, and uncertainty is where stress lives. This is why many traders exit profitable trades far too early. They tell themselves they are being disciplined. They tell themselves nobody ever went broke taking profits. But often the real reason is much simpler. They want relief. The profit has become emotionally uncomfortable. Closing the trade removes the tension. The position disappears. The uncertainty disappears. The stress disappears. At least temporarily. Then something interesting happens. The market continues moving higher. The trader watches from the sidelines. And now a different emotion appears. Regret. The trader begins thinking about how much more money could have been made. The early exit that felt safe suddenly feels painful. Notice the cycle. Fear of losing profits leads to an early exit. The early exit leads to missed opportunity. The missed opportunity creates frustration. And frustration often leads to poor decisions on the next trade. A single emotional reaction starts a chain reaction. This is one reason why successful traders spend so much time defining exits before entering positions. They understand that decision-making becomes more difficult once profits are involved. Money changes perception. A trader who planned to hold calmly for days may suddenly struggle to hold for hours once the position becomes profitable. The market has not changed. The plan has not changed. Only the emotional attachment has changed. Have you ever noticed how a small profit can sometimes feel larger than it actually is? A trader may have a gain that represents a tiny percentage of the account. Objectively, it is insignificant. Yet emotionally, it feels valuable because it is now real. The trader begins treating that profit as if it already belongs to them. Psychologists sometimes call this the endowment effect. People value something more once they feel ownership over it. The same thing happens in trading. Once profits appear on the screen, they feel owned. Any pullback feels like something is being taken away. That perception creates stress, and stress changes behavior. Traders become reactive. They abandon plans. They focus on protecting profits instead of following probabilities. The irony is that many traders spend years trying to avoid losing trades, while never realizing that winning trades are creating just as many emotional mistakes. The market doesn't just test your ability to handle losses, it tests your ability to handle success. Can you stay patient when money is being made? Can you follow the plan when profits fluctuate? Can you tolerate watching gains shrink temporarily without panicking? Those questions are often more difficult than they appear, because when a trade is losing, the fear is obvious. Most traders believe stress begins when a trade starts moving against them. They think the anxiety comes from the red numbers on the screen. They think the pressure starts when the market fails to do what they expected. But if you pay close attention, you'll notice something interesting. For many traders, stress starts much earlier. It starts the moment they need the trade to work. That one shift changes everything. There is a big difference between wanting a trade to succeed and needing it to succeed. A trader who wants a trade to work can remain objective. If the setup fails, they accept the outcome and move on. A trader who needs the trade to work is no longer thinking clearly. Now the outcome carries emotional weight. The trade becomes more than a trade. It becomes a source of validation. A source of hope. A source of recovery. And sometimes a source of survival. Have you ever entered a position and immediately felt attached to it? Before the market even moved significantly, you found yourself imagining profits. You started thinking about what the money would do for you. You began mentally spending gains that did not yet exist. At that moment, something important happened. The trade stopped being a probability. It became an expectation, and expectations create pressure. The market doesn't know what you need. It doesn't know whether you are trying to recover losses from last week. It doesn't know whether you are trying to prove yourself right. It doesn't know whether you need a winning trade to feel confident again. The market simply moves. But once you become emotionally invested in a particular outcome, every movement starts affecting your state of mind. A small pullback feels larger than it really is. A temporary pause feels dangerous. A normal fluctuation feels like a threat. Why? Because the trade is no longer being evaluated objectively. It is being evaluated emotionally. This is where stress begins. The need for a specific outcome creates tension because the future remains uncertain. The trader wants certainty. The market offers none. And the larger that gap becomes, the more pressure the trader feels. This is why traders often experience stress even when their setups are perfectly valid. The strategy may be sound, the risk may be controlled, the analysis may be correct, yet the trader still feels anxious. The issue is not the setup. The issue is attachment. Think about what happens after a series of losses. Many traders enter the next trade carrying invisible baggage. They tell themselves they are taking a normal position. They tell themselves they are following their plan. But internally, they desperately want the trade to work. Not because the setup is exceptional. Because they want relief. They want their confidence back. They want the pain of previous losses to disappear. That need changes behavior immediately. The trader watches the chart more frequently. The trader reacts to smaller movements. The trader becomes less patient. The trader starts searching for confirmation instead of information. Notice the pattern. The stronger the need, the weaker the objectivity. The weaker the objectivity, the higher the stress. And the higher the stress, the worse the decisions become. This is why some traders seem calm regardless of individual outcomes. It isn't because they know what the market will do. It isn't because they are fearless. It is because they have detached their emotional well-being from the result of any single trade. They understand that one trade means very little. A trade is simply one event within a long series of events. Nothing more, nothing less. Have you ever wondered why some traders become stubborn when evidence clearly shows they are wrong? The answer often lies in emotional dependence. If they need the trade to work, accepting a loss becomes psychologically difficult. The loss feels larger than money. It feels like failure. It feels like rejection. It feels like proof that they were wrong. As a result, they resist reality. They hold longer. They ignore warning signs. They search for reasons to stay in the position. The market hasn't changed. The need has changed. And that need is now controlling behavior. This is one of the most dangerous conditions a trader can enter because it is often invisible to the person experiencing it. Everything appears logical on the surface. The analysis seems reasonable. The decisions seem justified. But beneath the analysis is a hidden desire for the market to deliver a specific outcome. And once that desire becomes strong enough, every piece of information starts getting filtered through a single question. Not, what is the market telling me? But, how can this trade still work? Most traders believe watching the market closely gives them an advantage. The logic sounds reasonable. If you're paying attention, you'll react faster. If you're monitoring every move, you'll stay informed. If you're constantly watching price, you'll be more prepared. But in many cases, the opposite happens. The more a trader watches, the worse the decisions become. This is one of the hidden costs of watching every tick. At first, it doesn't feel harmful. A trader opens a position and begins monitoring the chart. Then a few minutes later, they check again. Then again. Before long, every small fluctuation has their attention. The problem is not the observation itself. The problem is what constant observation does to perception. Have you ever noticed how a small move suddenly feels important after you've been staring at the chart for an hour? A tiny pullback starts looking like the beginning of a major reversal. A brief pause feels like weakness. A normal fluctuation begins to look like a warning sign. Nothing significant has actually changed. Your perspective has changed. When you zoom in too closely, you lose sight of context. A trader who watches every tick starts reacting to information that was never meant to influence the trade in the first place. The market is always moving. Prices rise and fall constantly. Most of those movements are meaningless. Yet the human brain struggles to ignore movement. It is naturally wired to detect changes and respond to them. That instinct was useful for survival. In trading, it often becomes a problem. Because every movement begins demanding attention. Every movement starts feeling important. And once everything feels important, objectivity starts disappearing. Think about a trade that was originally based on a 4-hour chart. The setup looked strong. The entry was planned carefully. The stop loss was placed logically. Then the trader starts watching the 1-minute chart. What happens? Suddenly the position feels unstable. Small fluctuations create concern. The trader begins questioning the original analysis. Not because the larger picture changed. Because the smaller picture created emotional noise. This is where stress begins to grow. More observation creates more information. More information creates more interpretation. More interpretation creates more doubt. And more doubt creates more stress. Notice the chain reaction. The trader believes they are gaining control. In reality, they are increasing emotional exposure. Have you ever entered a trade and found yourself checking your profit and loss every few minutes? That behavior reveals something important. The focus has shifted. Instead of evaluating the market, the trader is evaluating their emotions. Every increase in profit feels good. Every decrease feels uncomfortable. The result is a constant cycle of emotional highs and lows. The market hasn't changed. The trader's attention has changed. And attention shapes experience. What you focus on expands psychologically. If you focus on every fluctuation feels significant. If you focus on every temporary loss feels threatening. If you focus on every small gain feels worth protecting. This is why many traders become exhausted even during relatively quiet market conditions. They are processing far more information than necessary. They are fighting battles that do not need to be fought. And most of those battles exist only because they are watching too closely. Professional traders understand something that newer traders often miss. More screen time does not automatically lead to better decisions. In fact, excessive monitoring frequently leads to overmanagement. Trades get closed too early. Stops get moved unnecessarily. Positions get adjusted without a valid reason. Not because the market demanded action, because constant observation created the urge to act. The human mind struggles with inactivity. When traders spend hours watching charts, they often feel pressure to do something, anything. Even when the best decision is to do nothing, that pressure slowly erodes discipline. The trader begins interfering with plans that were perfectly reasonable before emotions entered the picture. And the strange part is that this process usually feels productive. The trader believes they are being responsible. They believe they are staying engaged. They believe they are managing risk. But often they are simply feeding stress with unnecessary attention. Because every tick creates a new story, every candle creates a new possibility, every movement creates a new interpretation. And when a trader becomes trapped in that cycle, the chart stops being a source of information. It becomes a source of emotional stimulation. Most traders enter the market believing that one day they will finally feel certain. They think more experience will create certainty. They think a better strategy will create certainty. They think more indicators, more analysis, or more information will create certainty. And because of that belief, they spend years searching for something that doesn't exist. The market rewards probabilities. It does not offer certainty. Yet many traders continue behaving as if certainty is just one discovery away. Have you ever noticed how often traders search for confirmation before entering a trade? One indicator isn't enough. They add another, then another, then another. They look at multiple time frames. They read opinions. They search for news. They look for agreement from other traders. What are they really searching for? Not information. Certainty. They want reassurance that the trade will work. They want protection from being wrong. They want a guarantee. But the market has never operated that way. No chart pattern can guarantee a result. No indicator can eliminate uncertainty. No analysis can predict every outcome. Even the best setups fail. Even the strongest trends reverse. Even experienced traders get surprised. Uncertainty is not a temporary condition in trading. It is the environment itself. And this is where stress begins for many traders. The trader expects certainty. The market delivers probabilities. The conflict between those expectations creates pressure. Think about what happens when a trader enters a position expecting certainty. The moment price moves against them, anxiety appears. Why? Because the movement contradicts their expectation. The trader believed they understood what would happen. The market immediately reminds them that outcomes are never guaranteed. That reminder feels uncomfortable, not because the trade is necessarily bad, because uncertainty has returned to the surface. Now here's the interesting part. The traders who experience the least stress are not the ones who know the future. They are the ones who stop demanding certainty from the future. There is a significant difference. One trader enters a position believing they know what will happen.